Okay, so before we go on to today's topic, do you guys have any doubts that need to be cleared from the financial systems class?
Hello.
No?
Hello.
Yes?
Yeah, Nikhil here, ma'am.
Huh, tell me, Nikhil.
Good afternoon.
Good afternoon.
Yeah. Actually, I want to I want to clear about the OTC market. Can you explain with the little example?
So, let's say if I want to buy shares of Reliance,
Okay.
okay, my two options are either I can place my order in the exchange, which is the,
Oh,
let's say, NSE or BSE,
yeah, yeah.
or I can go to OTC market. So there, what I'll do is I'll find a broker.
Okay.
Okay, so I know the counterparty. That's the first feature of the OTC market.
Okay.
Okay. Second is because I know
Okay.
the counterparty, when I make a deal with them, I can negotiate on the prices.
Okay.
So he might agree to sell at, let's say, 100 rupees per share to me, but that person
Okay.
might have bought from another person at 90 rupees per share, but he's selling at 100 to me.
Yeah. Right. Right.
But I don't know that, right?
Yeah.
So
Right.
price is not transparent in the OTC market.
Yeah. That I understand. Actually, I want to ask when the OTC market, the buyers and seller meet through the broker, right?
Not always. Sometimes a buyer can know the seller directly.
Okay. 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 So, which in the exchange, they don't get the mode of like electronic mode, when they trade, they don't trade in the exchange, na? They trade directly. They buy and sell the securities or anything directly.
Directly, but they will need the depository to move the shares for sure.
Okay, okay.
Okay.
Maybe it happens in they usually happen in the exchange only. Na? That's why I'm asking. Usually, electronic selling and shares are happen in
OTC
the
is
exchange. So
also
OTC market.
electronic only. You'll learn more about this when you do your trade life cycle in your second level.
Okay, okay.
Okay, that is also
The second,
electronic only. It is not like you'll physically deliver any shares or anything like that. Both are electronic. The difference is in one you know your counterparty, in the other you don't know your counterparty.
yeah. Okay, okay. Okay. The one question I came through that one is question is there the share purchase and 10 shares. One share price is 25.5 between 25.7. So the answer is given 25.7. So can you
What
tell
is,
me the higher rate is given?
what is the question? Your question was not clear. What exactly is the question?
Like the share price of one share price is
Huh?
$25.5 between 25.7. So the question was the which price the share is bought, one share is bought. So the answer is given 25.7. Maximum price is given. So can you tell me why maximum price?
I'm not sure in what context was this given. Is it in the PPT or was it the assignment or because the
No, an
question
assignment, ma'am. Question
then
is simple, ma'am. Like one example.
I would need
Yeah.
the whole question for me to because I haven't set the assignment. I can't see the assignment.
Okay. Like, ma'am, the question is simple. Like they have given the share price of 10 shares and price of one share is given $25.5 between $25.7. And they have said key can you tell me can you tell the share bought and which price? So they have taken the price like of one share 25.7 maximum price they have taken. So
Okay,
that's what I'm asking.
either the question is incomplete or there is something missing from that.
Okay, okay. Well, I see to then I again ask you.
Okay. Any other questions, guys, before we continue with today's class?
No, man.
Okay, then. So, shall I start with today's class then?
Yeah, yeah.
Okay. So, today's topic is going to be cash equity. How many of you know what is cash equity? The rest of you, can you put your mics on mute, please, if you're not answering? Only if you're answering, unmute it and answer, or you can let me know in chat. Right? So, what is cash equity, folks?
It is the ownership of a company.
Hello,
Ownership of a company. Okay. What else?
ma'am. It is the liquid portion of investment that can be converted into cash, easily converted into cash or redeemed into cash.
Okay. Anyone else? Claim on asset of the company. Yes. Okay. So,
A part of an asset which can be converted into a cash easily in a short period of time, that is less than a period of 1 year.
okay. Not
For
necessarily
example,
less
gold.
than a
Or
period
ma'am, it
of
can
one
be,
year. It's correct. So,
or it can be
cash.
said that,
Mm-hmm.
or it can be said that the cash equity also refers to the common stocks that are generally issued to the public.
Yes, correct. So when you look at it, cash equity refers to the liquid portion of an investment that can be redeemed for cash easily. Okay. So in terms of investing, cash equity is commonly or generally referred to as common shares or ordinary shares. Okay. So what are shares, stocks, common shares, common equity is nothing but, can you guys mute your mics, please? Whoever's not speaking, there's a lot of interruption. Okay, so what are shares, stocks, common shares, or common equity is nothing but shares that are units of ownership of interest in an institution, or it can be a company, or basically whoever's issued shares that provide equal distribution in any profits. Is everyone clear with this? What is a share, or what is cash equity?
Yes, ma'am. Yes, ma'am.
Yeah. So write this down before we go on to what are the types of shares that are there. Prashant, can you mute your phone microphone, please? Okay. So we have mainly two types. You have something called as ordinary shares, and you have something called as preference shares. Right? So what are ordinary shares? Anyone?
Eh, Like when the IPO ma'am, happens, like the ordinary shares are issued, anyone can buy
Correct. So
from the
you
market.
have ordinary shares which are primarily issued by the issuer for the sole purpose of raising capital. And as mentioned here, the reason why they're raising capital is they want to expand. So rather than borrowing from banks and paying a high interest, they would raise the capital from the public. In return, they give the public something called as shares. So share would denote, or a share is a unit of ownership of the company. Okay, are we clear with this? Who all can issue shares?
Uh, Company, ma'am, like any company,
Companies, government,
government.
Government. Are you sure governments
No,
can issue
government, no
shares?
government. No,
Listed
government can't.
company.
Not issue.
So you have companies. What else?
Institution.
Companies, institutions, exactly. Institutions, who else?
Like whosoever wants to raise the money to expand their business, organizations.
Organizations, I
I
can
think
put them under institutions, right?
I think it can be listed and unlisted both, ma'am.
That will get to what is listed and unlisted, but
Oh,
I'm
okay.
asking who all can be issuers. So it can be companies, it can be institutions.
Government
For
agencies.
shares, no. For bonds, yes. Okay. The reason is, can you tell me a reason why government won't issue shares to raise capital?
Because you can't take ownership of any government organization.
Correct. Correct, exactly. You can't take ownership of government organizations. Okay, so that's why a government will never issue shares to raise capital, but they can issue bonds, and that what are bonds and all that will be discussed in the next class. Okay, so now that we discussed what are ordinary shares, what is the advantage for an investor or shareholders who buy shares, ordinary shares? What's the first advantage that they get? So first advantage is obvious, which is ownership. Okay. What else?
They can raise the capital.
Raise
Low
the capital
price
is
profit
Dividend.
sharing.
issuer.
Dividend.
Okay, one by one. Issuer
Yeah.
is the one who raises the capital by issuing shares. So I'm asking as an investor, what is the advantage? So one is ownership.
We
Like
get dividends.
Very
We
good.
get
low
dividends.
Someone
rates. Yeah.
said voting rights also in the chat. So voting
Voting.
rights.
Voting.
What does voting rights mean?
Like uh, they welcome the suggestions of the shareholders.
Okay. So
Or they,
voting.
if they want on the board of directors, like director of board, they in that case also works voting rights.
Okay.
Yes.
So what
Yeah.
else? This it is this it? Ownership, voting rights, and dividends.
Like they buy at low price also sometimes. Low pricing.
So you can put it as, if then buy it at a low price and sell it at a high price. So you can say capital appreciation.
Appreciation. Yeah.
Yeah. Okay. Capital appreciation, and you can say transferable, meaning ownership can be transferred from one person to another person. Yes or no?
Yeah.
Okay. So when you look at it, advantages for an investor if they invest in a share of a company is they get ownership, they get voting rights, meaning they can take part in the decision making of the company if the board of directors put a decision forward. They get dividends, which is nothing but if the company makes profits, then the company can pay the profits out to the shareholders in form of dividends, right? They can get capital appreciation, meaning they could buy the shares at a lower price and then sell it at a higher price in the market. And lastly, it's transferable, meaning ownership can transfer from one person to another person. Is this clear to everyone? Yeah.
Yes.
So
Yeah. Yeah.
what could be the disadvantage of owning shares? Is there any downside?
Yeah, by
The price could
fluctuations
go down.
down also.
Volatility.
So one this thing major obviously is price fluctuation because of the markets. Yes. What else?
Company winding up.
So they are the
Like
last
they do not.
people to
Yeah.
be paid if the company goes bankrupt.
No.
or winds up, right? What about
Yeah.
what else?
The dividend case also, and they
Dividends
lastly
is
get the.
not assured, right? Dividends is not assured.
Correct. So
Yeah, it's not.
dividends, even let me put it this way, even if the company, or rather I'll write issuer, even if the issuer makes profit, it is not necessary for him to pay dividends to the shareholder. To give you an actual example of this, you all have heard of Microsoft, right?
Yes.
Who owns Microsoft?
Bill Gates.
Yeah. Bill or Microsoft paid their first dividends 17 years after they went public. You think in those 17 years they didn't make any profits?
They did.
They did, right? They decided not to pay the dividends out to the shareholders. Can you think of a reason why they decided to retain the profits and not pay it to shareholders?
Like they invest that dividend
To
in some
invest
other
They
other like
reinvested,
avenues.
exactly,
to
they
ex-
reinvested the
reinvestment.
profit to expand more. That's why they didn't pay out the
That is
dividends
none.
to the shareholders. Okay?
No, in the dividend case, like it's the wholly depend on the company's choice. They have to distribute or not. Na?
It's based on the board of directors if they want to pay out the dividends to the shareholders or not.
Okay, okay.
Okay, so these are the disadvantages for a investor. Exactly. Also, another thing is, do shares have maturity on it?
No, they don't have maturity.
They don't have maturity, exactly.
No.
So no maturity. That means you are the shareholder till the company either winds up or goes bankrupt, or till you sell it to another person,
Self-esteem.
right? So that means, which implies your investment is tied up. Yes or no? Yeah. So your investment is tied up. So these are the disadvantages of holding a share. So write this down. Write down what are the advantages and disadvantages, and then we'll go on to preference shares.
Ma'am, I have a question. So very basic one. So when you say investor, even I can be an investor. I can buy these shares or preference shares, whatever shares they are. I don't have to be a high profile candidate, right?
For ordinary shares, you don't have to be a high profile candidate, you can be a retail investor. And for a retail investor, the easiest way to acquire a share is to go through a broker, like how you have your ICICI securities, Kotak securities. So before, in the olden days, if you had to buy shares, it was to be a very lengthy process. Now it's all simplified. The moment you open up a bank account, right, they only will ask you, do you want a demat account? The demat account will be your trading account. So the if you say
Okay.
yes, then you'll get, so after a few hours or few days, you'll get a call from the bank's the trading division or securities division, and then they'll say, ma'am, good chance to invest in this company, do you want to buy the shares? If you want to buy the shares, give authorization to transfer money into your account, and then we will buy the shares on your behalf.
Okay. It's done through a broker for us.
Yes.
Okay.
I have a question.
Go ahead.
Yeah, so I just wanted to know if this, ordinary shares and equity, they are the same, right?
Yes. Okay, so the next type of share we're going to discuss is preference shares. So write the heading down. So what are preference shares?
So these are shares that have preferential rights regarding dividend and repayment of capital.
Like
So,
retail.
like
Correct. And
whoever owns
Mhm. Go ahead.
yeah,
Whoever
so
owns
whoever owns
preference.
preference shares, yeah, so they'll be given preference first to in terms of paying the dividend and repayment of capital over the ordinary shares.
Correct.
Like
Anupam
they're
also,
preferred, yeah.
yeah, okay. So Anupam also says that given preference when it comes to giving dividend or returning the capitals after the business is wound up. So just a same reiteration of what Aditya says. Preference towards dividends. Preference shares has fixed rate of interest. I wouldn't call it fixed rate of interest. I would say fixed dividend. Okay, Anamika. So that's a
Like
good point. Your preference shares has fixed dividend and it is fixed at the time of issuing. So
the
when you look at
common people not care.
preference shares are those shares that are issued by an issuer usually to private investors or angel investors or HNI people. Okay, so
I'm sorry, ma'am.
mhm.
Can you tell me between the angel investor and HNI the same thing, na?
Angel, it's basically angel investors and private investors. So these angel and private investors are usually people who are HNIs.
Okay, okay, okay.
Okay, so what are the advantage for an investor to invest in preference shares or this thing? So one first advantage is you get fixed dividend. Okay, do you get ownership?
Ma'am. No, ma'am. No.
Nikhil
No,
says no.
ownership won't be provided.
Does
No, ma'am.
everyone agree? No ownership.
Yes, no
There,
ownership is
there be
provided.
ownership. Ownership.
There
We
is
we do get the
ownership.
ownership.
They
We
get
do get, yeah.
ownership because they have invested. They do get ownership. So they also have ownership. Do they have voting rights?
That's no.
Do they have
They
voting
don't have
rights?
voting rights. They don't have voting rights.
They
Okay,
do have voting rights.
they do have voting rights, except they vote only if the matter concerns them. Have voting rights, but only votes if the matter concerns them or the matter that they're putting to vote, if it has any effect on them, then only they would consider voting. Otherwise, they're not bothered to vote in the decision making of the company. Okay, what other advantage do they have? So as discussed, they get paid dividends before the ordinary shareholders, right? Also, they get paid before the ordinary shareholders.
Ma'am, I have a question. Okay.
One
Like,
second, let me
so,
just complete the
okay.
sentence. In case of winding up or going bankrupt. Okay, what's your question?
So paying out dividends still depends on the company, right?
Yes, but the difference is for a preference shareholder, when the preference shares are issued, at that time itself, the company will say per share will only give you so much dividends. So when the company
Yeah.
declares dividends for ordinary shareholders, whatever is the fixed dividend for the preference shareholder, that will be paid. So what could happen
Yeah.
is, let's say hypothetically, if I was company A and I gave you some preference shares and I said I fixed the dividend as $10 per share. Okay. And then I have the rest of the people who bought ordinary shares from me. Now I declare dividends, meaning I want to pay dividends. I tell for ordinary shareholders I'm going to pay them 15 per share. But you are holding preference shares and your dividend is already fixed as 10. So I'm only going to pay you 10, but I'm paying ordinary
Then,
shareholders 15. Is the difference clear now?
yeah, got it.
Saujanya, ordinary people have access to, yes, ordinary shares. They can have access to preference shares, but mostly preference shares are given to your, private investors, meaning who invest largely huge chunks of money into the company.
Ma'am,
Okay?
any minimum cap is also there, like
It depends
while
on
buying
the
the
board
preference
of
shares.
directors.
Okay, like everyone will be engaged in buying the preference share. That's why I'm asking.
No, that's what I said. Not everyone is buying preference shares. Mostly people go for ordinary shares. Preference shares are given to people who are private investors who want to privately invest in the company. When your company has this thing, when it's declaring, doesn't have to make the news public as to who are their private investors.
It can be traded also, ma'am.
No, that's a disadvantage which I was going to get to. Right? So
Okay, okay, okay.
write down what is preference shares and write down the advantage, and then we'll move on to the disadvantage. Meanwhile, there are a couple of questions here. So let's see. Can they be traded? We'll discuss that in disadvantage. Can we convert preference shares to equity at given point of time? We'll discuss when we're discussing types of preference shares. Increase in equity shareholders' income by way of issuing preference shares. Increase. Not necessary, Akib. That depends on whether the investor wants to invest in ordinary shares or preference shares, right? The Can they sell it at any moment they want? Again, we'll discuss that in the disadvantage.
Hello.
Yes, Divya.
Uh, I have a doubt regarding ordinary share. In case of decision making, not all the shareholders have the rights to voting, right? Only the majority, shareholder who's holding the more
No,
or majority.
no. Every
Okay,
person
fine.
who's holding shares has the right to vote.
Okay. Mhm.
Okay, every person who's
Fine,
holding
ma'am.
the shares has the right to vote.
Mhm.
The larger the chunk of shares you have, obviously the more weightage your vote will have.
Okay, fine, ma'am.
Hello, ma'am. I have one question.
Sure, Preeti.
First of all, I didn't understand Akib's question. Increase in equity shareholders' income by way of issuing preferential share. I didn't understand the question. What was it?
He just, I think what Akib meant was if investors invest in preference shares, it increases their equity holdings in a company, if I'm not mistaken. Right, Akib? Was that your question?
Okay. Apart from that, I just wanted to ask, what is the difference between interest and dividend? Because you told that dividends are paid, not rate of interest. So, what is the difference between the both?
In terms of your interest is like you've borrowed money and on that you're paying a return which is called as interest, like when you take a loan, correct?
Okay.
In this, in shares, the money that the investor gives, it's not returned to the investor because there's no maturity on the share. You're just giving
Mm-hmm.
them a share of your profit. That's why it's referred to as a dividend.
Okay. So the bonds in which bonds are basically type of loan. So it will
Yes.
be considered as interest.
Bonds are
Okay.
considered as a type of loan. The return a bondholder gets is interest, which is in terms of your bonds, it's referred to as a coupon payment.
Okay.
Okay.
Okay. Fine. Yeah. Thank you.
And then,
Actually, in my question,
mhm,
the question that I asked,
mhm.
Akif this side, so I was willing to know that if the equity shareholders earn more by issuing these preference shares because they'll get more dividend. Actually, I was trying to frame my question in this way.
Okay, first of all, your equity shareholder, if he's issuing preference shares, that means he's an issuer, right? Uh, he can't be issuing his own shares and buying his own shares.
Yeah,
Okay.
that is clear.
Your investor,
Yeah.
if he wants to increase his equity holdings in a company, he can buy a chunk of ordinary shares, or he can privately invest and own preference shares, or a mixture of both if he's up to it.
Okay, ma'am.
Okay.
Okay.
Anamika's question, what does voting right exactly mean? So, to put it in simple terms, Anamika, let's say if I was company A and I want to merge with company B, and I'm a public company, meaning I have shareholders. So, I want to let my shareholders know I want to merge with this company because it's a good business decision, but I also want your opinion as shareholders if you're agreeable. So what I'll do is I'll put this decision to vote to my shareholders. Is that clear now? And to what a voting right means? Yeah. So can I continue to disadvantages of holding preference shares? Yeah. So one major disadvantage is because it has fixed dividends, right? So if, let's say, if company is doing really well, so if company or if issuer is doing very well, ordinary shareholders can receive more dividend than the fixed. Yes or no? Right? Like that example I gave you. Although they get paid first, because their dividend is fixed, chances are if the company is doing very well, then what could happen is the preference shareholders may end up getting lesser dividend than the ordinary shareholders. Right? Another disadvantage, not transferable, meaning can't be sold in the secondary market. So unlike your ordinary shares, which when issued in ordinary shares, when it is first issued in the market, which market is it?
Market,
Primary,
Primary
Very
market.
prime.
exactly. And when
market,
Primary
you
market.
market,
sell
primary
it the
market,
second time around, that is secondary market. So it's
secondary
Secondary
market.
market.
not transferable, meaning it cannot be sold in the secondary market.
Secondary.
Okay, so these are the disadvantages of owning preference shares. Are we clear with this?
Yeah.
Yeah. So quickly write this down and then we'll discuss the types of preference shares that are there.
Ma'am, I have a question, okay? Uh,
Sure.
yeah. So how do you sell the preferences? If you want to sell the preferences, you need to find a buyer directly.
Yeah, that usually you have your investors, no, these big time investors like Warren Buffett. Then you have this French dude, I forgot his name.
Rakesh Jhunjhunwala.
Yeah. So
Rakesh
these type
Jhunjhunwala.
of people. Anupam says in ordinary preference shares, is there a guarantee over company assets? Yes, some preference shares also does that. The only difference is it's not listed like your ordinary shares. So in case if company goes bankrupt, winds up, still you have to pay your preference shareholders also, right? And they get paid before the ordinary shareholders. Okay, Anupam? Right. So we
Ma'am,
have,
ma'am, is there hello, ma'am.
yeah,
Ma'am, is there anyone tax disadvantage also there or not for investor? I'm talking about.
sorry, disadvantage we mentioned, no,
Ma'am,
here.
yes, means I'm talking about tax purpose. In case when I'm going to talk about the shareholders preference, the taxable income of the company is not reduced, or the taxable income of the company is reduced.
It is
Uh,
reduced when it
will you
comes
please tell
to
me about it?
preference share. I can't tell you too much in detail because that involves all your balance sheet and all, and
No
I
issue, no issue, no issue.
haven't
I'm
done
also
accounting. But
no, no,
yes,
no.
they do get a little bit of benefit on the tax if they issue preference shares.
That's why I'm asking about the financial burden of the market. So that's why. No issue,
Okay,
ma'am. Thank you.
just a they get a little bit of
Navarro,
exemption,
Navarro.
not a lot.
Urvisha, Urvisha, Navarro.
Okay, Nikhil says if a small investor wants to sell, how will the investor get a buyer? Again, either he can execute it on the exchange by placing a sell order, or he can find a broker who will then find him a buyer. Okay, Nikhil?
In case of preference PS, I'm asking, sir.
Preference shares, you can't sell them. You own it. You can only on your death transfer it or will it to someone else if the company
Oh,
still
that's my, but like
exists.
if you have once purchased the preference shares, then you can't able to sell lifetime.
No, unless the company is willing to take it back.
Okay, okay.
Okay,
Thank
that
you.
should answer your question as well, Akib. Is there a time value attached to preference shares? Okay, so like ordinary shares, also they don't have maturity. It cannot be transferred, so you're indefinite owner of the shares unless and until on your this thing you will it to someone else, or if the company decides to buy back the shares from you. Okay, right? So there are types of preference shares, and the major types that are there is, yeah, preference cumulative and non-cumulative, preference participating and non-participating, preference convertible and non-convertible, and preference redeemable and non-redeemable or irredeemable. Okay, so Saurabh, any company, I bet Facebook has issued preference shares, just that we don't know because Facebook doesn't have to make that knowledge public as to who are their private investors. Indian company, I'm not so sure. It could be Reliance, definitely would have had some people. Tata also would have had some people. Okay, right? So now on to types of preference shares. So let's take an example. Let's say company A. Okay, Saurabh, if you say so, Reliance, but like I said, they don't need to make the knowledge public as to who are their private investors. Okay, so let's get back to the topic. We are discussing types of preference shares, right? So what I'll do is, in order for you to get an understanding of what are the types of preference shares, let's say there's company A. It went public in the year 2000. So let's say, because it went public, it also issued some preference shares, it also issued some ordinary shares. Okay. So let's say for preference shares, since the dividend is fixed, they fixed the dividend as hypothetically, let's say $10 per share. Okay. For ordinary shares, as and when they declare what profits they want to pay out, they'll do it. Right? So the first set we're going to discuss is preference cumulative shares and preference non-cumulative shares. Okay. So let's say in the year 2000, when it went public, do you think any preference cumulative, preference non-cumulative and ordinary shares, do you think they would have received any dividends?
No, no.
Exactly. So no,
No, no.
no dividends. Okay. No dividends. Let's say in the year 2001, they didn't make any profits. Will anyone get dividends then?
No, no.
Exactly. No. Let's say in 2002, they made a little bit of profits, but they said they won't pay dividends to anyone. Will anyone get dividends now?
No.
Exactly. They are not. No one's going to get dividends now. Next year they made decent profits. They declare dividends, and they say for ordinary shareholders we'll pay 8. How much does preference non-cumulative get?
10.
Exactly, 10. How much does preference cumulative get?
10.
They get 10 for this year, which is 2003, plus 10 for the previous year, which is
Okay.
2002, plus they get 10 for 2001. Okay, but not 2000
One.
because that's
Okay.
the year that they went public. So preference
So it's a
cumulative.
cumulative.
Exactly. So what it means to hold preference cumulative shares is any missed dividends that are not paid to the preference cumulative shareholder, when the company pays the dividends, it will pay this cumulated dividend to them along with that year's dividend. Is that clear to everyone?
But ma'am, you told 2001 there is no profit for them. So how they will declare the dividend, ma'am?
It's up to the share board of directors, right? If they want to pay or no, right? No profit means obviously they can't pay anything, right?
Okay, okay.
Okay. Next year, 2004, let's say the company made exceptional profits. It decided to pay its ordinary shareholders 50. How much will preference non-cumulative get?
10.
Exactly. How much will preference cumulative get?
10 plus 10.
40.
Exactly,
10.
10, because there's no missed
10.
dividends.
Already
Previous,
paid. Yeah, it's
exactly.
already paid.
Previous year, the dividend is already paid. Is this clear with what is preference cumulative and preference non-cumulative?
Yeah.
Okay.
Yes, ma'am.
So we'll cover participating and non-participating. Then I'll give you time to write before we move on to the other two. Okay?
Ma'am, I have question in this. Can I ask?
Yeah.
Okay, I just want to ask that in case the company is in loss,
Hmm.
we are not talking about the scenario in which the company is not making any profit. So
Hmm.
the company has right that they are not paying any dividend. But
Yes.
in case the company is making loss, so
Hmm.
do they have to pay the dividend, or because they might have made good profit the previous year? So if they are making loss the other time, so do they have to pay the dividend to
Not
these
necessarily.
preferential shares?
No, not necessarily. If they can make it clear to the preference shareholders that they don't want to pay the dividends for that particular year.
Okay, and
Okay.
Hello.
But if
that will
you're
be
a
covered in the cumulative.
well, yeah, if now the year after that,
Hello,
if they are paying the dividends, then they'll pay that previous year's dividend to them. If you're holding a
in the
preference,
cumulative
yeah,
one.
if you're holding a preference cumulative, by the way.
Okay, okay, yeah, thank you.
Okay.
Hello.
Yes.
Yeah, I want to ask one question. Like, if we invest in some bonds and like FDs, we get a interest rate per annum. So in the case of the dividend, it's wholly companies like choice if they
Yes.
pay dividend or not each year. Not
Yes.
they have matlab, like pledged a fixed amount of return.
Yes, because the reason is, unlike your bonds or your FD, that is money that you're given sort of like a loan on which you're earning interest.
Yeah. Right. Right.
Okay, so in the interest of time, guys, let because we have only like an hour and 15 minutes, and I have a lot to this thing. Why does the company pay out dividend even if making instead of reinvesting? Why does a company pay out dividends even after making it? That is to retain a sort of goodwill to the shareholders, Anupam. So in future, if they're deciding to
Ma'am, I have a
raise,
question. Yeah. Hello.
oh, okay, sorry.
Yeah.
Let me just finish with Anupam's question.
Sure.
So the reason, even if the company is making a lot of profits and it's sharing its profit with its shareholders to increase the goodwill, right? And also, in case in the future they want to raise further capital, then they would get more investors, because obviously the investors would look at the previous shares they have issued, how much dividends they have paid, etc. Okay. What's the next question, quickly?
Ma'am, when we read articles and
Hmm.
we see things like this is a Series A funding for Byju's or White Hat Junior or something like that, what kind of investment funding is that?
Series A and all, it's type of class of shares that is like in terms of its pricing. Series A is usually high price shares. Okay, like when they issue it, they are issued at a higher price.
Okay, ma'am. Thank
Can you explain more deeply, ma'am?
More like it's like your how do you put it? There's this. We're going to talk about this market capitalization in a few minutes. We'll cover it then.
Okay.
Okay. Right. So let's move on to participating and non-participating. Right. So we'll take the same scenarios. 2000 went public but no profits. Was anyone paid dividends? No. 2001 didn't make much profits. So no. Oh, sorry. No dividends paid to anyone. Okay. 2002 made some profits, decided not to pay any dividends, so no one gets paid. 2003 made some decent profits, paid ordinary shareholders 8 per share. How much does non-participating get?
10.
10
Yes,
$10.
10. Okay, how much does participating get?
This will also get 10,
20?
I guess.
No, they only
20?
get 10. It's
20?
not cumulative. Okay,
Come
it's
on.
participant. Now, the next year, ordinary shareholders get 15, non participating get 10, whereas your
10.
participating gets 10 plus if any surplus profit is there. Meaning, if any extra profit that is set aside after paying the preference participating, non-participating, and the ordinary, if anything is left over, that is paid to the participating share preference shareholders. Okay, what does surplus mean?
Extra
Yeah,
fund.
or or
Extra
Extra
leftover.
liquidity with the company. Extra
leftover.
liquidity with the company.
Okay, so are you clear between what is preference participating and non-participating?
Yeah.
Yeah. So quickly write down what is cumulative, non-cumulative, participating, and non-participating, and we'll move on to convertible, non-convertible, and redeemable and non-redeemable or irredeemable.
Ma'am, in this, I have one question.
Preeti.
Ma'am, actually, in this 2002, when the company is making a small profit, so how the company can decide that they are not giving any to the preferential share? Like that is quite understandable in the case of ordinary shares, that they can decide whether they want to give or not. But how can they decide in preferential share? Because that is what the advantage of preferential share is, that they
No,
will get
the
dividends.
advantage of preference share is you get preference in terms of payment. You will be paid first if they're making a payment of dividends. It's not that okay, if we make loss also we'll pay you dividends. Is
Okay, so
that
if
clear?
they are making, yeah, that's clear. If they are making like a small profit, or like there should be any measurement, what kind of a small profit or what kind of, huge profit, even if they are making, so they have right that they are not paying to anyone.
It is up to the again board of directors. Like we said with Microsoft, they paid their dividends out 17 years after they went public. So even the preference shareholders didn't get dividends at that point of time for the 17 years. Everyone received their dividends only after 17 years. So whoever was holding preference cumulative shares of Microsoft, imagine that person's luck. All the
Yeah, right.
accumulated dividends they'll get in one shot.
Yeah. Okay.
Okay. You guys
Thank you.
finished writing what is preference, cumulative, non-cumulative, and participating and non-participating? Done?
Yes, ma'am.
Okay. So we'll move on to preference convertible and non-convertible. Okay, we'll take the same scenarios. So 2000 it went public, no dividends paid to anyone. 2001 no profit, so obviously no dividends to anyone. 2002 made some profits, decided not to pay dividends, so no dividends for anyone. 2003 made a decent profit, sort of, decided to pay ordinary shareholders 8. How much does non-convertible get?
10.
Exactly. How much does convertible get?
10.
Correct.
10.
Next year, exceptional profits, decides to pay ordinary 15. How much does non-convertible get? Exactly.
$10.
How much does convertible get?
10 plus surplus, sorry.
And
No,
20.
only 10. No, only 10. It is not a participating or it is not a cumulative. Understand that. Okay. So then what is a convertible preference convertible shareholder? A preference convertible share is, or the advantage of a preference convertible share is, after 10 to 15 years of issue, a preference convertible share can be converted to ordinary share. Okay, so in this example, this was issued in the year 2000. So let's say 2010 or 2015, depending on when the company's board of directors decide when you can convert it. Let's say they said 10 years after it was issued. So in 2010, if you're a preference convertible shareholder, now you have the benefit of converting your preference convertible share into a ordinary share. Question is, why would you do that? So non-convertible you cannot convert, simple as that. Okay, my question is, why would a
To get
preference, sorry,
to get higher
higher amount in what
It will be
terms?
traded, ma'am.
because,
It can
because
be
yeah, it can be traded.
shares
Good,
in the
Nikhil.
market,
And
And the
Komal
value of the
also,
share will be high.
Gave a good this thing. Chances are that ordinary shareholders are getting more dividend than the fixed, so they want to convert it to ordinary, or chances are they want to trade it in the market, so they convert the convertible share into ordinary share. Is that clear?
yeah, ma'am. Just one doubt is there, ma'am.
Hmm.
They are saying after 10 to 15 years, they give the choice to the investors. So matlab every company like decides like this, or it's up to the company remarks, like how they decision.
Traditionally, they take at least a minimum of 10 years.
Okay, like the company's decision has to take, or the company do not want, like company don't want, like they want convertible to the same ordinary shares, so they can
If
take the decision. It's compulsory to take the decisions
no,
for
no,
the
no.
company.
Understand it's the company's board of directors who have given preference convertible shares. If they're given preference convertible shares, then they also have to tell the preference convertible shareholders after how many years they can convert the shares into ordinary
Okay.
shares.
Okay, like that's why written preference convertible shares. Okay.
Yeah. Okay.
Okay.
So your next set is your preference redeemable and non-redeemable, or sometimes it's referred to as irredeemable. And when you look at the dividend payout, it's similar like how it's your convertible, right? But again, the difference is after 10 to 15 years, a preference redeemable share can be sold back to the company or the issuer. Okay. So why would a preference redeemable shareholder sell back his share to the company?
To get the more profit, man, like present share price.
Yeah, you mean like compared to ordinary shares, or let's say if ordinary shares are trading higher in the market, he wants to get that
Yeah, that
benefits.
rate they will.
Since he can't trade it,
Yeah.
he gives it back. Yes, that is one possibility. What else could it be? What other reason could there be?
To give back the ownership.
Give back the ownership. In other words, like, can you give a better explanation?
If like I'm having a business and I have 48, 49% of shares and someone else have 51% of shares. So if it could be done that case,
Increase
all the
the.
Then you would be like a major stakeholder of the company. Then that won't come here usually in this aspect. The other
Like,
reason could be is
promote.
if the company is not doing that well, you're stuck with this preference shares which you can't sell in the market, right? So you maybe want to close down your investment before the company goes bankrupt. That's why you want to return the shares. Yes, even unsatisfied with the dividends. Okay, is that clear? Right? So write down what is preference convertible and non-convertible, and preference redeemable and non-redeemable, and then we'll continue.
Hello, ma'am.
Yeah, tell me.
Yeah, so I was asking if this whole period of redeeming preference shares, if this is taking place during the time of a depression. Consider a case that there is a global depression or a country is facing depression. So what will happen with those preference shareholders? What are they going to face?
See, if the country is facing depression, not just your preferential, everyone will be facing a problem, right? The simplest explanation I can give is the issuer will not declare any dividends, no one gets dividends paid to them. On the worst case scenario, if the company winds up or goes bankrupt, the preference shares will be paid first before the ordinary shares, but still they'll be behind your bond holders and the loans that the company has.
So that means all in all, preference shareholders would be facing a loss.
Yes, they can be facing a loss. But
Fine.
then it will be the entire market, right? Even your ordinary shareholders also will be facing a loss.
Like the COVID times also, ma'am. Like everyone is
Yeah, that
facing.
is one this thing. So, Saurabh, redeemable shares are not, or preference redeemable shares is nothing but after a certain amount of years, which is stipulated by the board of directors, if the preference redeemable shareholder wants to return his shares to the company, he can return it and he'll be paid back his investment. Okay, and the reason why they do it is either they are not satisfied with the dividends that they're receiving, or company is maybe on the verge of going bankrupt or winding up. So before it does that, they want to close down their investment. So only if you're holding redeemable shares, you can give it back to the company.
Ma'am, just want to ask. One doubt is there. If top-notch companies are there, na, Amazon, Facebook in India also Reliance are there.
Hmm.
So if the person want to invest in the preference share because he or the investor know that this company will not go anywhere, like is a
Hmm.
backbone of the like country also.
Hmm.
So if investor want to invest in that, in the
Hmm.
small investor is there
Hmm.
who duly matlab, like new investor I can say that. So how they can approach like matlab,
They'll
if
have to
they
go through
want to
a
buy the
broker,
preference.
unless you are a let's say if you were a Amitabh Bachchan, or if you were Tata, Ratan Tata, this thing, then you can directly go to Ambani and tell them, hey, I want to invest, I want preference shares. Saurabh, non-redeemable is you can't redeem it. The only advantage that you get there is fixed dividends and preference over ordinary shares. Okay, are we clear with what
These
are?
are for the lifetime.
Yeah, are we clear with what is preference or the types of preference shares? Yeah. So now
Yeah. Yeah.
what we're going to talk about next is market capitalization. Have you heard of this term?
Yes.
Yeah.
Yeah. What is
Yes,
market capitalization?
Number of shares into the price of share is
price of the
the
shares.
market cap.
Very close. There's slight miss.
Number of shares issued uh, initially in the market.
No, number of outstanding shares, meaning the number of issued shares in the market. Okay. Into
Face value.
no current market price.
Current.
Okay, current market. PX is short form of price. Okay,
The
current.
price they are trading in the market.
Yeah. So let's say if company, hypothetically company A has outstanding number of shares as this much, and let's say the current market price is $10, then the market capitalization becomes how much?
Like
1 crore.
You guys need to start using American decimal system, because most of these investment banks that you work with will use American decimal system. Okay, so 10
10 million.
million, in other
million.
words.
10 million.
10 million.
Yeah.
Million.
Okay. So based on market capitalization, your companies are categorized in three ways. You have large cap, okay, where the market capitalization, or rather, you have large cap, you have mid cap,
Mid cap.
and you have
Small cap.
small cap, right? So small cap, anything less than 2 billion is considered as small cap if their market capitalization is this much. Anything between 2 billion to 10 billion is considered as mid cap. Okay, anything greater than 10 billion is considered as large cap, right? So this company would be in which this thing now? It will be classified as small cap, mid cap, or large cap.
Small cap. Small cap.
Small cap.
Exactly, because this is million. If there was like another two more zeros, then it would go into one of these buckets. Okay, are we clear with this?
Yeah.
Chip also, no? Large cap we say blue chip shares.
Yeah, large cap companies
Large
are
cap blue.
referred to as blue chip companies.
Yeah.
Okay.
Okay.
Ma'am, and when you say current market price, it's the price of one share in the market, right? That's
Exactly.
$10.
Yes. So let's say if tomorrow, if the price is $9, then the market capitalization would be 9 into 1 million, which will be 9 million then.
None.
Okay.
Okay. Our outstanding shares and issued shares are the same. Issued shares would be what are issued in the market that could be
At the time of
subscribed.
IPO.
Yeah, at the time of IPO, that could be subscribed. Outstanding, which are currently trading in the market.
The total number of shares that it means.
Yeah, total number of shares that are trading in the market.
Okay.
Okay. Are we clear with what is market capitalization?
Yeah.
Okay, so write this down quickly and then we'll move on to what is, we're going to talk about IPOs. So before we talk about IPOs, we'll talk about where does these IPO shares come from.
Ma'am, I have a doubt. Uh,
Yeah,
hello.
yeah, tell
Yeah,
me.
number of outstanding shares and issued shares are similar.
No, see, issued shares are usually discussed in times of IPO. So I can say I issued 1 million shares, but out of that 1 million, let's say only 900,000 was bought and subscribed. So they are outstanding in the market.
Oh, okay, fine.
Okay.
Okay, ma'am.
Done?
Ma'am, this the categorization of the mid cap, large cap, and this can vary according to the country, or is it the same for all the
It's
countries?
same for all the countries. So you will have to do the, what do you say, conversion if you're taking into account Indian rupees.
Right. Yeah.
So can I continue?
Yes, ma'am.
Okay. So
Yes, ma'am.
shares are issued uh, through something or from something called as authorized capital. And how is this authorized capital derived is from something called as total capital equity. So what is total capital equity is nothing but what is your total liabilities. What is liabilities?
Company's debt.
Something
Like
something that
that.
we owe.
Yeah.
Debts and everything, right?
Obligation.
Total liabilities minus your total assets, right? That gives you your total capital equity. Okay. So let's say hypothetically the total, sorry, it's the other way around. Okay, your total assets minus your total liabilities. Okay. So let's say total asset worth is around 20 million. Hypothetical numbers, folks. Okay. And your total liabilities for now is, let's say, hypothetically 8 million. So what will become your total capital equity now? 12 million. Yeah. Your
12 million. 12 million.
total capital equity becomes 12 million. Okay. Out of this, a certain percentage of your total capital equity is set aside as authorized capital. Okay. how much percentage that is dependent on the board of directors, how much they want to set aside. So for this example, how much do you guys want to set aside out of the 12 million? In terms of, you can either give me in terms of percentage or in terms of amount. 4 million, 10%, Nikhil, 50% or $50? Okay, so okay, let's say 50%. So now that will make it 6 million, which is 50% of the 12 million. Okay, this percentage is again, as I said, decided by the board of directors. It doesn't exactly have to be 50%, it can be even less or it can even be more. Is everyone clear till here?
Ma'am, I want to ask one thing. What do you mean by the statement shares are issued from authorized capital?
That's
As
what
in,
I'm going to discuss that in few minutes now.
okay.
Is everyone clear here? How we got this authorized capital? Yeah. Now, further, this authorized capital is further divided into issued and unissued. So, authorized capital is further divided into issued and unissued capital. Okay, so out of this 6 million, let's say issued capital will be 4 million. Again, the split is decided by the board of directors. Okay, and unissued, or in other words, it's also called as treasury capital, is the remaining 2 million. Okay, now this issued capital is used for your initial public offering or to issue bonds. Okay, and this is used for your FPO. What's an FPO?
Follow-up public offering.
Follow-up
Further public offering.
further public offering, and for something called as DRs, which is your depository receipts, which we'll discuss a little later in class. Is it visible now, the screen? Okay, so what I meant by saying that your shares are issued from authorized capital, it is issued from this part, which is your issued capital. So a company who set aside this 4 million in an IPO can choose to issue maybe 400,000 shares at a price of, let's say, $10 each, or it can decide to issue, let's say, 4 million shares at a price or face value of $1 each. Does that answer your question?
Okay, that means company should have that much amount with itself, how much it is
Definitely.
trying to raise from the. Okay.
Not raise from the public, it is what they are planning to give to the public. Do you know what's the difference between a face value and the price of a share? So we'll take this
I
example.
think price of the share at the present
IPO.
price they are trading.
Okay, let's take this example. So company has issued capital worth 4 million. Okay, so let's say it decides to issue one million shares, okay, at a face value of, let's say, $4 each. Okay. Now, when the IPO happens, these shares can sell at anything or above, can sell at above $4. Okay. So let's say in the IPO, investor bought this share at, let's say, $10. Okay, this is the price he paid for the share in the primary market. Is everyone clear till here? $10.
Yeah, ma'am.
Yeah. Now, after a couple of years, company declares dividend. When it declares dividend, it makes the announcement, I will pay 10% of face value. What's the face value now?
$10.
No. That's
$10.
no.
For
Four.
It is
$4.
$4. Okay, 10% on face value, which is the face value of the share, not the current price of the
$11.
share. $11. From where did you get $11? Okay. Also, if the company is winding up or going bankrupt, it will pay this face value back to the investor. Okay, not the $10 that the investor has invested in. Is that clear with what's the difference between face value and the current price of the share?
Uh,
Okay?
Hello.
Yeah.
Confusion is there actually when the company issue like IPO at the rate of $4.
He's issued
Hello.
shares with the face value of $4, but when he sells it in the
Okay.
primary market, he's saying minimum you have to pay me is $10 per share. But it's clear to the investor that the face value is $4. This face value is
He's telling the
important.
primary market, ma'am.
When he's selling it in the primary market, he's selling it for a
Okay.
minimum of $10.
Okay.
Okay, the face value is important when the investor receives dividends, because dividends will be paid on the amount of the face value, not on what is the current price of the share in the market. Okay, is this clear, guys? So quickly write this down because we have only half an hour. I have to cover IPO and then I have to cover depository receipts. So quickly write this down and let me know so I can continue. Okay. Meanwhile, if you can have your reading material open, if you have it, and flip into the cash equity side. Did you guys get any reading material? No.
Yeah, on the
Yes.
LMS.
No, you should have got a physical this thing unless you haven't gone to the center. If anyone has the physical copy of this thing, does anyone have it? The physical copy?
No, no.
Okay.
yes, ma'am, I have.
You have? Okay. Can you flip into the cash equity chapter and go into the criterias for IPO listing?
Yeah, ma'am. Just a
Okay, and
second.
just keep it ready, okay?
Ma'am, can we get the physical copy from the center?
If you walk into the center, they should be able to give it to you.
Oh, no.
Just check with them though before you walk in.
Sure.
Can they email it to us?
You can reach out to Sadaf and ask.
Okay.
Okay.
Ma'am, are you referring to the handouts on LMS?
No, they actually give you a physical copy. It's like not many pages. Like each chapter has like some 4 5 pages. It's just like a gist of this thing, which is usually what is there on the PPT as well. Saurav, I didn't understand your question. Who is not Saddam? Saddam is Saddam Hussein, who is dead long back ago. Right? Saddam is the governance for CIBOP. Okay. Were you not there in the batch launch day? That day, Sadaf, the center head, yes, he's from Marticus. Are you guys done? Can we continue?
Hello,
Yes.
ma'am.
Yes.
You're talking about the notes that are wholly given in the LMS also?
See, your LMS has your PPTs, right? This
Yeah, PPTs.
handout
Yeah.
that I was talking is like a physical file.
No, that's clear, ma'am. Like the material is also given in the LMS, and we can see from here also.
Yeah,
That's
you
not
can
also.
see from there also, but it will take time to log into LMS, right? So I just wanted a quick
Yeah, yeah.
this thing.
Okay. Okay.
Okay, so I don't know. So the timing today was given till 5. I might be able to stretch till 5:15 or 5:30 because I think the next batch for the other trainer who's using the same this thing will start at 5:30. But we'll try to finish in a good pace. But yeah, there's still quite a lot. Can I continue? Yeah. So the next is we're going to talk about initial public offering. So initial public offering is nothing but when a issuer decides that he wants to expand and he wants capital to expand. So instead of going to a bank and borrowing, one option for him is to issue shares to the public. Okay. So the first thing that happens in an IPO is first you have to pass the criteria to go public, right? So who was the person who had that reading material? So if you could just read out that criteria for us, please. Oh, by the way, this criteria was listed for specifically for Indian market. More or less globally, most of the markets follow the same this thing. Yeah. Was it Jayashri who had it? The reading material?
Yes, ma'am, I have, but criteria exactly I'm not able to find out, ma'am. It's first is what is an IPO and why an IPO.
Then I think in the next page, if you this things flip it, there should be a page that says criteria, securities regulation act, something something, and then there should be like 3 sub criterias. It's not there.
I'm just searching, ma'am, just 2 minutes.
Okay, so meanwhile, from what, yes, Anupam, that is one criteria in the Indian market. So the first criteria usually is a company should have a certain amount of authorized capital or certain amount of issued capital that is set aside. In the Indian market, if I'm not mistaken, that has to be more than 10 crores. Okay, are we clear with this? So issued capital that they have to set aside has to be more than 10 crores. Okay. Then you have this SEBI's Securities Exchange Act of I think 1952. Then you have SEBI regulation of some year that I forgot off the bat what is this thing. That has those criterias have to be adhered to. The third is there are 3 sub criterias. In that sub criteria, one is you have to show distributable profits for at least 3 years. Okay. Then you have to show that you would be able to distribute dividends at least 2 out of 3 years. And also you should show that you have tried to list the company in the past 3 years. Out of these three sub criterias, any one criteria you can have, right? And then the last criteria that is there is the main one. You shouldn't have any ongoing open cases against you as a company, like any lawsuits or everything. If anything is there, it has to be closed before you seek to go for listing. Okay, this will be mentioned in your PPT as well. All right, so every market or every securities regulator will publish a list of criterias that need to be met in case if a issuer decides to go public in that particular market. Is everyone clear with this? Okay, so the next bit, which is the important bit, is appointing the participants in the IPO. So in an IPO, let's say the first participant that's going to be appointed is called as the lead manager. Okay, and it is usually your investment banks. What does the investment bank do as a lead manager? I'll just put it here. What does the investment bank do as a lead manager? So first is underwriting. We discussed what was underwriting in your financial systems class. Do you guys remember? Yes or no? Yeah.
Yeah.
So first is underwriting. Next, they help in drafting the prospectus for the IPO. What is the prospectus? Prospectus is nothing but A to Z of the
Brochure.
company. Yeah, sort of like a brochure, you could say. A to Z about the company as to why they're planning to list, why they're trying to raise capital, who is the CEO, what is the type of business they are into, etc. etc. Okay, they help to draft the prospectus, and once the prospectus is drafted, it is sent to the securities regulator for, I don't know why this line is coming in between, for approval. Okay, if the regulator marks any changes to be made in the prospectus, then it is referred to as red herring prospectus. So nothing but, so once these guys help draft the prospectus and it's sent to the regulator for approval, if the regulator wants any changes to be made in the prospectus, it is highlighted and sent back. At that point of time, it is referred to as a red herring prospectus. Okay, it's just a name given. So as lead managers, your investment banks do underwriting, help in drafting the prospectus. Okay, help in pricing of the IPO shares, meaning it helps the issuer decide what price to sell the shares at. Is everyone clear till here? Yeah. Also,
Yes, ma'am.
it helps to drive the road show, where road show is nothing but tells the syndicate member where to go in order to get prospective investors. Meaning, the lead manager tells the next member, which is your syndicate member, where to go in order to get potential investors. Okay. So your syndicate members can be banks, or most likely it's also your investment banks. They act as both lead managers and syndicate members. Are we clear as lead managers what they do, or the first participant of an IPO what they do? Yeah.
Can you
So
please
Yeah.
explain once again what is syndicate members?
I'm getting to that. Syndicate members is next. I was just talking about lead managers as of now.
Okay, yeah, that is clear.
Okay. So syndicate members is the next participant in your IPO. This thing. Syndicate members are usually your banks, or it can be your investment banks as well. So as syndicate members, these are the ones who faces the public and promotes the company, right, to get investors. So basically, they are the ones who face the public and get the investors. Okay. They're also the ones who collect the potential bids. What is potential bids? What are potential bids?
Potential bids could be like investors who would be investing, like future
Yeah,
investors,
exactly.
and
Bids in terms
Good
of
and yeah,
price.
how many shares an investor wants to buy with the price at which he wants to buy at. Okay. So potential bid is nothing but if an investor, once the syndicate member has spoken to the investor or the potential investor, and the investor is interested to invest in the company, he'll submit his bid to the syndicate member, meaning he'll say how many shares he wants to buy, at what price he wants to buy it at. Is this clear? Is this clear? Yeah. The third member, I don't know why these lines keep coming up. The third member is called as your registers. Okay. Example of registers is, have you heard of Kavi? Kavi Infotech. It's a
I've heard, but don't know much about it.
Kavi brokings or
no, Kavi registers. They have a part that is a brokerage as well. Okay.
they are registrars or register?
Registers or registrars also they are called. Okay.
Same thing.
Yeah. This guy is the bookkeeper of the IPO, meaning he is the one who records who all are the lead managers, syndicate members, registrars, and bankers, which is next. Okay. He also records all the potential bids. Who collects them is the syndicate member, who records them is the registrars. Why? because once the shares are allocated, you need to know how many shares goes to which person who is bid or which investor. Okay, is this clear? And the last participant that we have is your banker or bankers. Your banker is where the potential bid amount is. Someone needs to mute their mic, please. Is where the potential bid amount is kept in an escrow account. So, for example, let's say an investor submitted a potential bid of, let's say, hypothetically 100 shares at, let's say, $20 per share. So this 20 into 10, which is $2,000, is kept in the escrow account. So once the shares, let's say if the potential investor receives the 100 shares will get issued in his name, and the $2,000 that are kept in the account is transferred to the issuer. Okay, is this clear? Is this clear, guys? What's an escrow account? Yeah. Now the question might be, what would happen if the investor doesn't receive the shares? Then what would happen with the money? If the investor doesn't receive the shares, then his or her money is returned with some interest. Okay, so let's say whoever this investor who bid for 100 shares for $20, the IPO happened, the shares got allocated, he didn't get 100 shares, or he didn't manage to get the 100 shares. His money, which is 2,000, is returned to him with some interest. Why with some interest?
Because they were holding their funds for a while.
Yes, if he kept that money in the bank, he would have at least earned some interest, right? So this is like, because he had to keep it in the escrow account, he's not earning some interest. That's why, and he kept it there because he was expecting to receive shares. But since he didn't receive any shares, his money was returned to him with some interest. Is that clear?
How long does it take
once the
to return the
IPO,
money?
Once the IPO starts, or once the regulator gives permission, there is roughly about 21 days in which you have to finish your IPO, meaning issuing the shares and allocating the shares.
Okay, so they will pay the interest for 21 days.
Yeah.
Okay.
Okay. Is this clear with?
It happens. It happens usually, ma'am. Like most of the companies use IPO. Like this happens.
Actually, they've come up with a better way now. So before, what was to happen is these investors, they used to put the money in the escrow account, and sometimes what was to happen is they won't get the shares, they won't get the money back also. So it became a big problem. So what happened was, then they came up with this new thing called as the ASBA account. So it stands for application supported by block amount. Now what happens is, until and unless the shares are issued in the investor's name, that amount that is kept in the ASBA account will not be transferred to the issuer. Okay, so that saves the investor. It's to protect the investor. Okay, so do you guys
Okay,
want?
and ma'am, one more question I have.
Uh-huh.
Who is liable to return this money? The bank holding the escrow account or the company who is issuing the share?
The bank that is holding the money.
Okay, so they will pay from this $2,000.
They have to pay the $2,000. The interest that they have, this thing that the issuer will have to give.
Okay, that means the company who is raising the fund.
The money will be kept at the bank. If something goes wrong with the money, the bank is liable because it's kept at the bank, right?
Yeah, right.
Right. But the interest, in case if the shareholder doesn't get any shares, the interest that they receive is on behalf of the issuer to pacify them because they didn't receive the shares. And mind you,
Okay.
this bank is not doing, all of these guys are not doing this for free. Understand, they're charging like a huge hefty sum of money from the issuer.
Yeah, okay.
Okay.
You have said that in the IPO there are multiple IBs companies that there, investment bankers are there.
They can have more than one lead manager, so they can have even up to 10 lead managers.
Okay, like some parts of, like they give the some parts of the IPO or shares, some parts of the share that we
No,
should buy this lead manager.
no. See, as a lead manager, you underwrite 10%. So if you have 10 lead managers, 10%,
Okay,
that
huh.
makes it 100%. But
Okay, okay.
now, if the shares are fully subscribed, then they don't have to do underwriting, right?
Right,
Right.
right.
Sometimes what can
Right.
happen is the lead managers itself can entirely buy the issue size in the primary market if the issuer is agreeable, and then they can sell it in the secondary market. Sort of minimum, obviously, you should have one lead manager. Maximum, you can have how many you want based on the issuer's decision, because understand that for each lead manager, you're paying him for a service and he doesn't come cheap. Did I say max 10? I said the up to 10 is also possible. Okay. So you guys want to write this down, or maybe after you see the recording, you'll write it down, because we are close to 5 o'clock and I still have to do the pricing and the allocation, and I have to talk about depository receipts.
We can write it
Ma'am,
later.
this
That's
is
fine,
there
I
in the
guess.
Yeah,
LMS,
we'll write
right?
it.
I mean, the like it's presented in the LMS, all the things that you explained just now.
Not in LM, yeah, I mean, in LMS, it's the reading material that is there, but this recording link will be sent to you guys. This session that is conducted right now, a recording will be given to you guys. A video recording, by the way.
Okay.
Okay. So is it okay if I continue?
Yeah.
Okay.
But in the PPTs and Learntron, I mean, they have explained whatever you've explained just now, right?
Yeah. It's basically what is there in the PPT is what I'm covering. It's just more in a layman term or in a more understandable way.
Okay.
Okay. So Akib, escrow account is nothing but a account in a bank that where third party people can keep their money or this thing. That's why it's called as an escrow account. Okay. Right. So I'm going to continue. So we'll do an IPO in class. So quickly, I'll need you guys to submit a bit. So the next bit we're going to cover in this thing is how are the IPOs. So we covered appointing. We're going to talk about pricing of the IPO shares. Okay. So pricing is done by, you have two methods. Pricing of IPO is done by two ways. The first method is called as, I don't know why this line keeps coming up, fixed pricing. So as the word suggests, or this thing, the price is fixed for or per share, and it's mentioned in the prospectus. So what happens in fixed pricing is directly the issuer will say, per share I want, let's say, $8. That's it. They won't give you what do you say, bandwidth of price, like, so it's this, between this much I want the price. Directly they'll say, per share I want $8. So if you want to buy a share, you have to pay me $8. Okay, is that clear? Is that clear with everyone? Yeah. Next you have is something called as book building, or it's also called as price discovery. Okay, book building or price discovery. So in this, what happens is, uh, they'll give a cap price and a floor price. So cap price is nothing but maximum how much they want per share, and floor price is minimum how much they want to get for share. So Saurav, we are saying page layout, and then where? Or I'll figure it out later, right? Okay, since we're pressed for time. So book building or price discovery is where the issuer would want to discover how much he can get per share. So what happens is they give a maximum price they want to take per share and a minimum price they'll take per share. So let's say company A decides to issue, how much is this here? 1 million shares. Okay. Cap meaning maximum per share they'll take is $15. Floor price minimum they'll take is $10. So what I want you guys to do now is give me a bid. So let's start. Bids. Give me a bids quickly. I won't take actual money from you, so you can buy huge chunk of shares. Saurabh is saying 100. I'm going to increase it to 100,000. Okay, Saurabh? 100,000 at 85. No, maximum is you have $15 per share or minimum $10 per share. So what's it gonna be?
1 million, 2
40,
million, ma'am.
45. Saurav,
2 million at the rate 10.
2 million at
10.
2 million at 10. But there is only
I'm
1
like,
million
this
shares,
is,
no?
oh, sorry. Sorry. Okay, 1 million I am talking about. Okay.
So wait, Saurav, I'm going to
Well,
put on behalf of you. I'm just putting a price now because I'm not. Okay, Nikhil, how many shares at what? Between 10 to 15? How much? So one is saying 500,000 at 12, 100,000.
200,000
Okay, 200,000 at what? 100,000 at 13,
at 13 and 14. 14 had been
200,000 at
11.
14, 1 million at 10. Someone wants all the shares at 10. All shares for 10. Two big bids. Okay, I'll just make this a little less. Okay, 1 million is possible. Then entire lot will go to 1 million, but then that will be difficult to allocate. So, or rather, it will be one person who's holding the entire amount of outstanding shares, which no issuer would prefer actually. So, I won't take that bid as of now. Okay, if we had maybe 10 million shares, I would have definitely taken that bid. Uh, okay. 80,000.
I just want to ask why will investor like buy at the high price? You are giving the cap between floor price and cap price, na?
If you are
Invest.
desperate to get the shares, you will obviously bid at a higher price, no?
Okay, okay, okay. In that case, okay, okay.
Okay, so 700,000 at 11. Okay, I'll take that also. Okay, so now what we'll do is we'll stop the bid as of now because obviously this is more than 1 million. Okay, right? So is this more than 1 million? Five, six, yeah, more than 1 million. All right. Now, what happens is we're going to discuss about the allocation of the shares. The allocation can be done by something called as uniform. I'm going to write it here. Allocation can, or rather the price, it can be done by something called as uniform pricing or discriminatory pricing. Okay, so if we do discriminatory pricing, what will happen is they'll see first which is the highest bid in terms of quantity and they'll start allocating. So in this bids, the highest is 700,000. So this one first gets the shares. Out of 1,700,000 is removed. Who's the next highest? Is 500,000. But there are only 300,000 shares left. So this person will get next at a price of 12. The remaining people, what money they have kept in the escrow account will be returned with some interest. Is this clear to everyone? Yeah. Suppose this is now obviously an over rate of interest that will be decided by the board of directors what to give. Okay. Suppose now in this case this is oversubscribed, right? So what could happen is instead of giving only to these two people, they can decide to give, let's say, maybe 100,000 shares to each person, or maybe 150,000 shares to each person. So first person whose highest bid is this thing. So what happens is this person would get maybe 150,000 shares instead of getting 500,000 shares at 12, meaning at whatever price they bid. Okay. What return of interest, Preeti? There is, as of now, there is no return of interest. You're just investing, right? You're giving a certain amount. So, whatever is the face value on that, you can get dividends. In this case, we haven't discussed the face value here. We're just talking about at what price it is sold. Okay. And back to this thing, as you were saying, if it is oversubscribed, the issuer can decide to give a certain number of shares to each person or each bidder, but they would take this bid amount that the bidder has given. Is everyone clear? So that way, what happens is instead of just two people getting the shares in this case, now at least everyone will get some amount of shares. Is everyone clear with this? Yeah. That was your discriminatory pricing. If it is uniform pricing, let's say I'll just add another bit so we'll get a nice round off number here. Okay, so we have a total of how many bits? 8 bits, right? 25% of 8 is how much? 2, if I'm not mistaken. Correct, no? 25% of 8?
Two.
Yeah. So 2 bids in terms of the least quantity and corresponding price get cut off. So the least bid here in terms of quantity, 1 is this one. Okay. And then we have 100,000 at 14, 100,000 at 13, and 100,000 at 11. So these 2 bids in terms of their price gets cut off. The remaining is added. The sum is how much here? And plus 23. So that makes it a total of 76. So 76 gets divided by how many bids are remaining now if you remove the other 2. So it is 6 bids, right? So this 76 gets divided by 6. So each price becomes 12.6. Now what happens is, who's the highest bid? 700,000. Instead of paying 11, this person has to pay 12.6. Whoever's getting next, let's say this person, now instead of paying 12, has to pay 12.6. This is for uniform pricing. Okay. Is everyone clear with this? So how it works is 25% of the total number of bids in terms of least quantity and corresponding price gets cut off. Remaining prices are added and averaged, and that average price is paid by all the bidders. Okay, is that clear?
So what happens to 11 and 12 that highlighted? It's a little confusing, the highlighted
No,
portion. You're not taking.
no, if these people still get the shares, they'll get the shares, but now instead of paying 11, they have to pay 12.6. That is only in terms of calculation, these prices get cut off. Okay. Yes,
Okay.
uniform and discriminatory price come under book building method. Okay, is this clear? Okay, so this will be there in the recordings. So that is your whole of your IPO method. Okay, appointing of, so we talked about criteria, appointing, we talked about pricing and how the shares are also allocated. Okay. Now question is, let's say if an issuer wants to raise capital in a foreign country, what he can do is something called as depository receipts. Have you heard of this? No? Okay, that's okay. So let's say if I was a company based in India and I want to raise capital in the US market, meaning I want in dollars. I want to raise capital in dollars. Okay, so I can go and do something called as a depository receipt. How that works is, company based in India will approach the depository in US. So the depository in US is called as DTCC. Okay, it will tell the depository, hey, I want to raise capital in your country, issue depository receipts for me. Not in India. You're trying to raise capital in the US, so you're going to a US depository. If a foreign company is trying to raise capital in India, then it will go to NSDL. Okay, Saurabh? So, went to the US depository and said, hey, I want to raise capital in your country, issue depository receipts for me. The depository contacts a local custodian. Where is that local custodian? Where the company is based. So the local custodian is also based in India. So in this case, let's say SBI. What the local custodian will then do is collect the shares from company A. Once the shares are collected, the local custodian will inform the depository shares are in custody. Once that is done, then the depository will issue something called as depository receipts in the US market. More specifically, since this is the American market, it's called as the American depository receipts. Is the flow clear to you guys?
Yes, ma'am.
Yeah. Do you want to quickly write this down? It will be there in the recording. If you want to write it down, you can write it down. Okay, quickly write it down. So I've written it down here also. See, I put the numbers. So one company approaches depository and says, I want to raise capital in your country, issue depository receipts. Company pays for issuing the depository receipts, by the way. Okay. Depository then contacts the local custodian and says, collect the shares from company A. Company A gives the shares to the local custodian. Local custodian informs the depository shares are in custody. Once that information is given, then only the depository issues depository receipts in the market. What's your question, Nikhil?
Local custodian in the US only, ma'am?
No,
Like
India. That's
SBI
why it's
branches.
written. That's why it's written India, no
Okay.
here. Okay, it's not local custodian in US. Clear? Let me know once you're done, okay?
Ma'am, one request. Please, can you repeat this flow?
Sure. There's company A, it wants to raise capital in the US market. So it approaches the US depository, which is DTCC in this example, and says, I want to raise capital in your country, issue depository receipts for me, for which company A pays the depository to do so. Understand, no one does anything for free. Once the depository gets this notification from company or request from company A, it will contact a local custodian where the company is based. So in this case, it is India. So it will go to India, find a local custodian, let's say SBI for example, and tell them this company wants to raise capital in our country, collect shares from them. So once the custodian gets the shares from that company, it will inform the depository, I have the shares in custody. Once the depository gets that information, it will then issue depository receipts in the US market. Because it's issued in the US market, these will be called as American depository receipts. Is this clear to everyone now?
Okay, so it is issued by depository or the government of America?
Depository. Why government of America? Government of America does not issue securities. The one who can issue the security on behalf of a issuer is the depository. We discussed this in your financial systems class, remember?
Yeah, right. Yeah, I remember.
Yeah.
Okay.
Okay. Is everyone clear with this flow now?
Yes, ma'am.
Okay. The first successful American depository receipt was done or was JP Morgan Chase helped a British retail store called as Selfridges to do an ADR, obviously in America, and this happened in 1927. Okay, right now when a company issues or pays the depository to issue depository receipts, this is called as sponsored depository receipts. Okay, the reason why I'm talking about this, we'll talk about something called as unsponsored receipts. So we just talked about how the depository receipts are issued, right? How is it priced? So usually every depository receipt has a number of underlying shares. That's why your depository tells the custodian to collect the shares from the company. Okay. Clear? Okay. Now, let's say one American depository receipt for company A consists of 10 shares of company A. Is everyone with me so far? Yes, the company has to hand over the shares to the custodian. Okay. Right. So let's say one ADR of company A will consist of 10 shares of company A. And let's say one share of pay hand over. Does the company have to pay to hand over the share? No, they don't have to pay. They just have to hand over the shares to the custodian. That's it. They pay the depository to issue the receipt. Okay, which is a service that the depository gives. Now let's say one share of company A in the Indian market is trading at, let's say, RS 100. Okay, that means one ADR in terms of Indian rupees would be how much? 10 into
70.
1000 rupees, right? Yes or no?
Yes, ma'am.
Yeah. So now, but this ADR is not trading in the Indian market, right? It's trading in the US market, correct? So let's say if one US dollar hypothetically equals, let's say, 100, or to make it, let's make it 200. Hypothetically, okay? This is not the actual rate. That means your one ADR in US dollars would become how much now?
Five. Five.
20,
Five.
5, correct.
$5.
It will become 5. dollars. How is this? This is your 1000 divided by 20. Okay? No, sorry, 200. 1000 divided by 200. Okay? Is this clear to everyone? So if the share price in the Indian market goes up and down, the share price in the US market also can go up and down depending on the exchange rate that is also there. Is that clear?
Yeah.
Okay. So what are some of the advantage of investing in a depository receipt? Someone mentioned it before, foreign investment, meaning as an investor, you can invest in a foreign company now. Yes or no? Yeah. Also, you have the same advantage like a shareholder, ordinary shareholder, which is ownership, voting rights, dividends, yeah, transferable, meaning can be traded in the secondary market, right? Capital appreciation. Okay, so same as a ordinary share, you get ownership, voting rights, dividends, transferable, or capital appreciation. Okay, the disadvantage, what could be some of the disadvantages?
Fluctuation of currency.
Yeah, so exchange rate fluctuation. Yeah, exchange rate fluctuation. Then what else?
Issuer
If the
have to pay good
organization
amount to
Sorry.
okay, so issuer have to pay good amount to the depository.
No, we are talking
That will
disadvantage
be
in terms of investor, not in terms of.
ma'am, if the organization fails in the foreign market,
Mhm.
if the organization fails in the foreign market, it will impact on the Indian market to its home market.
Again, we are talking about from issuer's perspective. I'm talking about from investor's perspective. So for an investor, one risk is obviously the exchange rate fluctuation, right? Cannot be split. What you mean, the underlying shares? That is obvious, right? It cannot be split, right? Uh, Currency value, because when dividend is paid, let's say if Indian company is declaring dividend of, let's say, like 100 rupees, that will be like few cents, right? For a US person. Would it make logical sense for that person to actually claim the dividend if it's just few cents? Right? So currency value also could be a risk versus their domestic currency. Okay. So foreign investment, and also someone mentioned diversification, which is good. So diversification.
May it depends upon the tie between the both the countries.
Sorry, what?
A relationship between two the countries, both the countries. It's any
That
effect on this?
no, that doesn't have any effect on this.
Okay.
Okay. So that is the advantages and disadvantages of investing in a depository receipt. Another disadvantage is it is only traded in the market it is issued in. For example, ADR, which is American Depository Receipt, can only be traded in the US market. It cannot be traded anywhere else outside the US market. Okay, so that's a disadvantage as well. Is that clear? Yeah. So similarly, you have something called as IDR, which is Indian Depository Receipt. So the workflow will be same. The difference will be this will be a foreign country. So foreign company. Like let's say if this was a US company, it wants to raise capital in India, so it will approach NSDL, which is the Indian Depository. Then the Indian depository will contact a local custodian in the US. So let's say maybe Bank of New York Mellon. It will tell that custodian collect the shares from that company in the US. That company will give the shares to the custodian. Custodian will inform NSDL. Then NSDL will issue something called as IDR, which is Indian Depository Receipt. So the workflow will be the same. Is that clear? Yeah. And then you have something called as global depository receipts. The difference here will be this will be called as a global depository. So we'll go back to the same example. Indian company wants to do something called as GDR. So it approaches the US depository, which is a like DTCC is a global depository, and says instead of doing ADR, do a GDR. Then again the depository will tell collect the shares. Once it gets the shares, now instead of issuing an ADR, it will issue a global depository receipt. Now the difference between an ADR and a GDR is an ADR can only be traded in the American market, whereas a GDR can be traded on any of the global exchanges that are there. So you have some of the global exchanges, which is the London Stock Exchange, your Singapore Stock Exchange, your Luxembourg Stock Exchange. They're all global exchanges, which is your global stock exchanges. Are we clear with what is a GDR? So unlike your IDR and ADR, where ADR can only be traded in US market and IDR can only be traded in the Indian market, your GDR can be traded on global exchanges. Workflow will be the same. Only difference will this will be a global depository. Is everyone clear till here? Okay. Now remember I said when the company pays the depository to issue the depository receipts, these are called as sponsored receipts. Okay. Sometimes what could happen is the demand for the sponsored receipts in the market might go high. So let's take this example. This company told the depository you only issue 10 receipts in the market. And when the depository issued the 10 receipts in the market, the demand of these receipts went very high. If the demand went high, what happens to the price?
Price will
Increases.
be higher.
Exactly. The price will go high. So in case if the price goes very high, in order to stabilize the price, the depository might make a decision to issue something called as unsponsored receipts. So let's say if this gets copied over. Okay. In that case, what happens is this all doesn't happen. There is no shares given to a local custodian. There is no, what do you say, company paying the depository to issue this thing. So what will happen now is, because the sponsored receipts price is so high, in order to stabilize the price in the market, the depository would issue something called as unsponsored receipt. It will be clearly mentioned it is an unsponsored receipt. Is everyone clear till here what I said? Yes or no? Yeah. So then what will happen is, if an investor buys an unsponsored receipt, the only advantage he gets is capital appreciation. Why doesn't he get the other advantages, like these specifically? Why doesn't an unsponsored ADR holder get only capital appreciation? Why he doesn't get voting rights, ownership, etc.?
Company is unknown.
No, company is known, na. Because company didn't pay the depository to issue unsponsored receipt. Why will they take the responsibility of giving dividends to unsponsored receipt holders when the company itself hasn't paid the depository to issue unsponsored receipts? Unsponsored receipts issuance is solely the depository's decision. It didn't even take the company's permission to do so. Okay? Is this clear? Yes or no? So I'm going to repeat it. What happens is, because the sponsored receipts in the market, the demand is high, supply is low, the price increases drastically. If the price increases drastically and it's causing a problem in the market, then what happens is the depository makes a decision on its own to issue unsponsored receipts for which the company has not paid for. Okay, so it is clearly mentioned it's an unsponsored receipt. So the investor, when he buys that receipt, is clearly aware that it's an unsponsored receipt. The only advantage he's going to get there is capital appreciation. That's it. Okay, so you can have unsponsored ADRs, IDRs, but you can't have unsponsored GDRs, because it will be very difficult to manage unsponsored GDRs, because they are globally, they can be traded, meaning bought in one market and sold in another market geographically.
Ma'am, in the GDR case, like it can be traded in the any like in the UK also
Yeah,
globally.
as long as it is listed in this, if it's a listed
Any
as a
permission
GDR.
required, anything required.
So
Okay.
for example,
And if we
no, see, look, for
yes,
example, you have Aditya Birla, which is a GDR. Let's say when it
okay,
was first time issued, it was issued in the London market. You can now buy it in the London market, you can sell it in the Luxembourg market. So geographically, it's different markets.
I have a question.
Hmm.
Does the share price value differ from country to country, market to
Yes,
market?
it will, because of the exchange rate and all, it will differ.
No, ma'am. Due to the exchange rate, the price would be the same, na, ma'am, of the share.
How?
Like it would be it would be converted in euros or it would be converted in US dollars, but the share price would be same, right?
Underlying share price is dependent on what is the price in the Indian market. Then obviously, in terms of the exchange rate, it will differ, right?
Okay, ma'am.
it will be automatically converted to present, like which country they are trading.
Huh. So these are some of your examples of your ADRs, meaning Indian companies
Ma'am,
that.
I'm trying to say like a share price of Aditya Birla is 70 rupees in Indian market.
Huh.
Okay, ma'am.
Huh.
When we will convert it to US market, it would be $1
Huh.
approx.
But
Right, ma'am.
in
So it
UK
yeah,
market,
UK would be
70
different. Yeah.
rupees.
Is it possible like if Aditya Birla having 70 rupees per share in India and having more than $1.5 in America?
Based on demand and supply? Yes.
Yeah, yes, ma'am. Based on demand and supply.
Yeah, yes.
Okay, ma'am. Thank you.
Okay. So here are some of your Indian companies that have done ADRs, which is Infosys, ICICI, HDFC,
Ma'am,
Lockheed.
last question,
Huh.
please. Sorry. So what I if I have a global scenario, so I can purchase Indian share, like I can purchase a share from India, and I can issue or trade it in America. So
If it's a GDR.
GDR, yes, ma'am.
Yeah.
So
So
if I buy if I bought a share on rupees 70 rupees, like in India, so I can buy that on $1.5 in America, right, ma'am? Due to GDR.
no, you'll have to be buying a GDR, not the share. So, for example, let's take this example of Aditya Birla. In India, when you buy Aditya Birla, you're buying Aditya Birla shares. Okay, clear?
Okay, ma'am.
Okay. Now, if you want to sell these shares in the US market, you cannot, because these are shares that are listed in the Indian market. However, let's say in the London market, you have bought a Aditya Birla GDR. Okay. You can sell it in the US market.
Okay.
Okay. So same goes for, let's say, Infosys shares. In India, you have bought Infosys shares. In the American market, you have bought an Infosys ADR. And now, if you want to sell that ADR, you can only sell it in the American market. You cannot sell it in the Indian market.
Okay, ma'am.
Mostly prefer GDR, na, so they can trade anywhere.
That is this thing. It depends. But then GDR has its own set of this thing where you would have to, track it, keep it this thing, and all of that. That's why you don't have unsponsored GDR. Whereas you can have a unsponsored ADR and IDR. So with that, your cash equity class is done. I'm sorry we had to rush through this thing. In fact, 2 hours, 2.5 hours is actually not quite sufficient to cover everything in this thing. So I felt it was a bit rushed. Hopefully, you guys are okay. Anyway, the recording will be given to you guys. Okay, hang on 1 second. Okay, guys. So I'll have to stop it now because